Hello and happy Saturday. Figured it would be a good idea to try and touch base and give you a very brief video, just kind of synopsizing some of the things that we're doing. I don't really want to get into the minutia of tariffs and the whole world freaking out about it, whether it's important or not, whether it is accurate or not. Honestly, none of that sort of stuff truly matters when you're running a systematic investment system. And so, what I hope to do in the next 10 or so minutes is just kind of give you a brief overview of what we're running and why. And I think it's important for us to take a glimpse into how our models are set up, how they're functioning, why they're doing what we're doing, some of the things that have taken place over the last couple of days when markets obviously got pile drived, pile driven, whatever it might be. Any rate, so bottom line is that we use a systematic investing system. It's a modeling program that is designed to be very structured. It's designed to be rules based. It allows us to be able to make investment decisions without any form of emotion entering into the equation or entering into the picture. And when it comes to investing, I think that that's an incredibly important process. So again, a rules-based approach. It is driven essentially by quantitative analysis. It's driven by forms of machine learning and fuzzy logic. For those of you that really want to know an in-depth conversation about machine learning and fuzzy logic, there's tons of resources available online if you'd like to learn or read more about that. But we have a very structured set of predefined algorithms that eliminate any form of need of emotion or intuition. And I think that's important. Um, I guess if you want to think about it, maybe think of it as in terms of a recipe. Instead of guessing what might work, we just simply follow a very clear set of instructions based on data, based on patterns, and based on logic. And even though markets at times, like what we've seen recently, are very illogical and emotional, and clearly the last couple of days was some very high degree of panic selling. And that's fine. Typically, when we see that kind of panic-driven move, it gives us an opportunity to identify what bottoms might look like. So basically, just again, back to our systems. Generally speaking, again, I don't want to get into the weeds of exactly the mathematics behind how our algorithms are set up and built, but I do want to give you just a broad overview. Generally speaking, the system starts with just gathering a lot of data, and in terms of stock prices, economic indicators, company earnings, market trends, even different forms of alternative data, like in some cases, social media input. That provides some sentiment indicators that create a really robust platform that the system can learn from. Uh, Computation power has become incredibly valuable, incredibly powerful, and we're doing everything we can to leverage that to help identify better within the world of growing forms of AI, how to acknowledge that uh, uh, markets can just often be disruptive, and markets can in some cases be irrational. And so we want to make sure we're being rational anytime the environment is irrational. And so bottom line is that the more robust the data that we're dealing with, the better the system can see what's happening, if you will, right? So the programming systems use rules and algorithms. So it applies basically a set of pre-programmed rules. Uh, and this is just an example, but specifically speaking, if we're thinking about how our programming works, it functions by utilizing seven different individual portfolio structures that are designed to do different things. Some are momentum based, some are tactical asset allocation, some are focused on market timing, some are focused on identifying buying dips when they occur in market space. Some are based on not just identifying whether or not the dip is buyable, but whether or not the dip is designed to be avoided. And those are all important elements when it comes to building a robust machine learning style system that is a systematic approach to investing. Again, which is what we use. But I'll give you just a basic example of a rules-based type algorithm. We don't necessarily use moving averages per se. We'll use rate of change of important elements like price, volume, and volatility combined in a mathematical component to give us a sense of how an asset class is functioning under those three sets of criteria. A lot happens underneath the surface of price. And everybody sees price, the index value or whatever it might be, but oftentimes can ignore the volume and the volatility components, and those are incredibly valuable. Oftentimes, organizations will use moving averages. I don't love moving averages, and we don't use them within the construct of our algorithmic systems. Why? Because they're a single factor. A 50-day moving average is just simply a single factor of price and how it's moved over the last 50 days. Same thing for a 200-day moving average. But when you're considering a rules algorithmic-based system, to give you a very, very simplistic example, the rule could be stated in code form something like buy a stock if its 50-day moving average, say, crosses above the 200-day moving average. Sell if the price drops 10% below its peak, that sort of thing, right? That's what I mean by a very rules-based algorithmic system. The automation that is designed inside the programming is a function of, again, training itself and training the systems on the data that it takes in. And a ton of data comes in from the flows of markets as they exist in and through the options market. And that's very, very, very heavily, I don't want to use the word manipulated, but that's heavily controlled by the biggest of the big fund managers on the planet, and pensions, all that sort of stuff. So it matters how money is flowing, and it'll help us to identify and pick up flows of markets that can then identify whether or not the market itself is risk on or risk off or something in between. The reality is that nothing in the world is perfect. But what's kind of cool about the machine learning rules-based algorithmic systems that we've got in place, the systematic investing approach, is that it learns. And it learns based on the data. It learns based on the movement of price, volume, and volatility. It learns based on the flows of money and how it's functioning. And that gives us an eye into what's happening beneath the surface of price. And so the automation process is simply that once the rules are set within the particular model that we're utilizing, and we basically use three different models for portfolios dependent upon how your individualized risk was tested out. And that's why it's important on roughly a quarterly basis. You'll get an email from us just asking you how you feel about markets and about how you feel about your financial future. It gives us a glimpse into how you're viewing risk at that moment. Because what's interesting, I think, and important about risk identification, risk profiling, and all that goes with it is that we tend to be more risky than we want to be when things are going great, and we tend to be less risky than we should be or need to be or can handle when things aren't going so great. And so risk profiling is as much of an art as it is a science. And the programming that we use to try and help identify how you view risk has been very helpful. And those quarterly emails that come to you give you an opportunity to express your view of risk at that moment. And there are some instances where someone's life has changed fairly dramatically in some cases where their risk needs are in fact very, very different. In other cases, it's just environmental. Too much news watching. If I can prescribe anything for you, try not to watch news. It's really not good for your health. But point being is if you find yourself steeped in tremendous amount of negativity, which of course the news cycle is built on, fear sells, you often find yourself responding to risk profiling in a very, very different way than you otherwise would. So just be cognizant of that. Be careful of that. We try very, very hard to make sure that we're utilizing modeling systems specific to what your risk profiling says. But I am the world's worst mind reader, and so therefore, if something changes in your world, I really need to understand it, and I really need to know. And so that's where those quarterly emails are helpful. But nevertheless, once the automation is put in place, it just simply scans the markets on a basis that is primarily focused within the last 30 minutes of trading. Now, it takes into consideration the entirety of the day, but the last 30 minutes is where you tend to see major institutions changing their positioning or changing their flows or upping or down, pushing down their flows, whichever it might be. So the systems are designed to identify that, and it basically allows for this automation process to help us figure out what is the most appropriate thing to do, which of course the algorithms will pick up and then tell us. And so the system, I don't want to say that it has a brain of its own, but of course, machine learning, fuzzy logic, AI, all that stuff is trained on what's happening in real time as markets move. And markets move simply based on the flow of money. And so if we can identify how those flows are impacting markets, not just domestically, but globally, it helps us to put in place the best positioning and best portfolio allocations that are possible under those set of circumstances. And again, we don't have to think or worry about emotion entering into the equation, uh, which, look, everybody's human, me included. And there are instances where when markets are going through an extremely difficult time, it could be very, very easy to ignore what the signals say simply because it's really uncomfortable. And we just don't let ourselves do that. We don't let ourselves succumb to the emotion of the moment. We just simply follow the rules-based, mathematically structured, algorithmic system, focusing on flows of markets that give us the best indication of how we should be set up risk on or risk off. So there is good risk management baked into the system. And I'm going to share with you the back-tested results again. I've shared them before. I've sent them along. And it's valuable simply because the programming was set up in such a way where the code was adjusted and structured dependent upon how it performed in a multitude of different market cycles. How do you do that? Well, computing power, AI, machine learning, all of that has made it extremely possible to simply take the algorithms and place them on the market at a specific time and date, and then allow that market cycle to run moment by moment, hour by hour, day by day, and just let it run to see how did it perform on a monthly and annual basis? What did it look like? Were there things that were not great? And if so, how can we adjust the code system in such a way to give us a better result, a better outcome? So before today's video is over, I'm going to share with you some monthly numbers just to give you some just a reminder about difficult markets and how they often play out based on the systematic approach that we have, based on the systematic approach that we use. And I think that's important. I want you to recognize and understand we're not just willy-nilly, throwing stuff around. We're not sending money off to a third party somewhere. We're actively managing your portfolio based on a rules-based system, no emotion. We're just simply following the rules that were identified by our algorithmic programming. So, and right now, I think, given the amount of emotion that's in markets, I think that's super, super valuable. And if you think about a systematic approach, kind of like what we're using, you can think of it sort of as like, oh, I don't know, a good example, maybe like a GPS for your money, right? You tell it where you want to go, growth, high returns. Some of you have been willing to accept a higher degree of volatility to chase higher returns. And we definitely have some models that we've put in place for some who will do that. And to get there, we've got to go through some volatility, like I explained when we made the shifts. And that's okay, right? If we can adjust our thinking to not worrying about the narrative of the day, the news of the day, the fear being driven by CNBC or markets in turmoil programming or whatever it might be, tweets on X, whatever. If we can get past all that and just simply recognize that we're following a very well-structured system, emotionally it'll feel much better, and in the long run we'll do just fine. And I'm going to share with you the numbers here in a moment. But GPS for your money, back to that real quick example, if you just simply tell it what you want, uh, that GPS is going to calculate the best route based on real-time traffic, which we could view as market data. It'll give you a map, which we can view as our model, and then you put it in place, right? Now, is GPS foolproof? No. I mean, you can run into a situation where maybe there's a car wreck that the GPS system didn't pick up in time for you to take a different route to go around that slowdown, right? Markets can be unpredictable. Markets can be irrational. But, however, if we take into consideration how machine learning, fuzzy logic, AI components, and all the things that go into play in building these kinds of things work, it can give us an indication that more often than not, even amidst all the uncertainty, unpredictability, and just overall irrationality of markets, it can push that behind us, right? And again, I wish something was 100% perfect all the time. It's not. It just doesn't exist. But we're certainly doing better than what markets are doing right now based on how our algorithms are structured and functioning. And the quantitative type analysis that we use is super, super deep and beyond the scope of today's video. And most of you could care less how that coding works, and nor should you care. But a real world example of this that some of you may have heard of in the past, there's a hedge fund that has been around for a very, very long time. Jim Simmons is the guy that created it. He's since fairly recently passed away. But he created a company called Renaissance Technologies, and they utilize forms not too dissimilar to the kinds of machine learning, fuzzy logic, quantitative analysis that are built into our mathematical algorithms. Of course, no one knows exactly how their algorithms work because you can't become a client of theirs. You need to be an employee to invest in the direct fund of Renaissance Technologies, or if you attempt to get into their hedge fund, the minimum investment is quite large, multiple millions to get in. But that quantitative, non-emotional, mathematically driven algorithmic approach has performed really, really, really well for how Renaissance Technologies does it. Now, am I saying that we're Renaissance Technologies? No, that's not what I'm saying. What I am saying is that we're using technology not too dissimilar from what they're using, right? And so I think it's just important for us to recognize that the kinds of systems that we are using in general are designed to create for us an environment that will do two things. Number one, restlessly and relentlessly look for opportunities to buy into the market when risk is acceptable. At the same time, provide a degree of risk management that when markets view or look like they are really, really, really creating some really serious risk-off types of cycles, that's paid attention to, and that the algorithms trigger a dramatic reduction in exposure. And I can give you a real world, real-time example of that just simply based on what we've experienced this week. So going into the market close on Wednesday, which is when our algorithms trigger, the programming suggested that we should cut exposure to the equity market for Thursday's trading session by a fairly substantial amount. And for our main modeling system that has several different positions in it, which I'll share with you in just a moment, it cut our exposure on Wednesday night going into Thursday's trading session to just roughly 53% domestic equity exposure. And the bond exposure that we had at that time was roughly 14, 15, 16%. As you know, interest rates have been dropping on the long side of the yield curve. So the 10, 20, 30-year treasuries yields I try to mention that sort of stuff in my morning emails when it looks like it's important and pivoting. And so you can go back and review several of my emails if you like, but you know that I talk about rates a considerable amount. But going into the Thursday session, our algorithms triggered that there was a risk-off scenario in play and that it was not yet a buyable opportunity. And sure enough, Thursday's trading session was not buyable. Then at the close of Thursday's trading session, our algorithms triggered again, and it suggested cutting stock exposure even farther, which we did. Our equity exposure was cut down to 37% for US equity exposure, and our bond exposure was increased to 29%. Was the right move. Now, did we have stock exposure? Yes, we did. Were we fully exposed? No, we were not. Did bonds do really, really well in Friday's trading session? Yes, they did. Did it make sense for our model to increase bond exposure as much as it did, even though we saw interest rates drop as much as they did on Thursday? And the answer was, yeah, it made sense to do that. So the algorithms gave some real-time indication that it was identifying a very interesting risk-off environment. At the end of Friday's session yesterday, uh, the algorithms triggered risk on. Now that's interesting because most people would not have had the emotional gumption to be able to buy the market with that kind of a panic sell-off. But in most cases, when you get VIX, which again is just the volatility indicator for the S&P 500, it closed over 45. That's pretty rare. And in most instances, when you look back at market cycles that have had VIX close over 45, you see some positive returns out over 1, 3, 5, 6 weeks, 3 months, 6 months, 12 months. There's very limited times in market cycle history going back for the past roughly 35 years where we've seen VIX close over 45 that has created an increasing negative return cycle for the markets. 2008 was one. This is not 2008 by any stretch of the imagination. We do have a monetary policy situation where interest rates are declining and anticipated to decline much, much farther. We have a quantitative tightening scenario that is loosening up and getting very, very close to stopping. Those are all things that are very different than prior to the housing collapse. And any of you who are out there looking for homes right now will know that we're nowhere near a housing collapse. So two very different cycles. So nevertheless, that's a real world example and a real world situation that can, I think, help you maybe better understand what it is that our algorithms will do and how they view things. I'm going to take just one moment and share my screen. And when I do that, I'm going to go through some monthly returns that that will hopefully give you some indication of how this stuff works. So, okay, so you should be able to see my screen right now. Let me blow it up a little bit more for you. This is the quantitative analytics that I spoke of earlier that simply allowed for us to take the coding and drop it on the market cycle and then run the computers forward as if it existed at that moment, at that time, to produce the net results of what this mathematically driven, algorithmic, systematic investing approach gives us. And there's some things that I want to point out. So, of course, over the last 2 months, the modeling has created a negative cycle, right? You can see right here, 2025, March and April, where portfolios are off anywhere between 3.8 for 3.9, so call it 4% for March, 4.5 for April. And we say, oh goodness, that's terrible. What are we going to do? How's this going to work out? Well, let's go back to some other market cycles that were similar, where we've had two back-to-back months with this kind of depth. And really the only place that we can find that is in January and February of 2009. Now, why is that important? Because that's when the market bottomed. The market technically bottomed in March of 2009, and it was off to the races from there forward. You can see March after the February drop ended up for this particular investment programming 7% and then 3 and then 2 and then it was off a little and then up 3, so on and so forth. So 2009 was a very positive year for this particular program and how this model works. And in fact, it was on the heels of 2008 and 2007, of course, 2008, where markets were terrible. This is the S&P 500 in 2008, down 36.8%. This particular systematic modeling approach was up 12. Let's go back to 2000. Everybody remembers, most of us remember what 2000 brought. It was a 3-year bear market, essentially. And this is the S&P 500 here, down 9.75, almost 12, 21.5. This programming gave us a net positive result over those annualized times. But during that time, we had some volatility that we had to deal with. Here's 2000, 2001, and 2002. And you can see there were instances where we had some volatility. We had some bouts of some difficult negativity to have to deal with. But yet, those 3 years ended up positive. Most recently, we can talk about how things worked out in 2022. We can see how the model provided for recovery and then a dip and then recovery and then dips and then good recovery. I have no idea what markets might throw at us now. I have no idea what kinds of things the market in general is willing to do based on the narrative of the whole world coming to an end because of the whole tariff situation, right? So bottom line is that the market certainly is responding to fears of slowdowns for a number of different companies. However, if we really want to study the impact of what may or may not happen in tariff land, we have to recognize that the United States is the third lowest tariffed country in the G20. Most everyone else tariffs us far, far, far higher than what we tariff them. And some people agree with this statement, some people don't, but I think it's important and it's founded in reality. The vast majority of countries in the world don't just want to invest with us or trade with us, they need to. So whether you agree or disagree with the tariff situation doesn't matter. You'll find me to be extremely apolitical when it comes to investing. There are no political engagements that occur within our risk modeling or within our systematic investment approach. None. We don't care what the political cycle is doing. What we care about are what are market flows telling us. And are they telling us to be risk on or risk off? That's it. That's all that goes into this. There's no emotion. There's no politics. It doesn't matter. Okay? It's super important that we recognize that, because when you watch TV and you see what the S&P 500 is doing, don't necessarily think that that's exactly what's happening to us or how it's going to play out, right? And yeah, we've got some volatility over the last couple of months. We're doing everything we can to help minimize that. If we think about just the S&P 500 itself, for Thursday and Friday, it was down roughly 11% in 2 days. Now, that's a lot. That's very rare. Our portfolios on average are more moderate style portfolio that the majority of people that we're blessed to serve are tied into and using was down about 5% over that same time. So less than half of what markets did. I think that's important. Now, are there some portfolios who use a much greater degree of volatility and risk in an attempt to go after greater returns? And the answer is yes. And if I showed you some of the back-tested results of how those particular models have done, it's amazing, right? There are some years where we had 100, 150% returns, but there's also a cycle where the worst it did was about a down 30% range. So we've got to deal with some volatility for the more aggressive stuff. The less aggressive stuff, like what I've showed you here a moment ago, is more predominant what most people are using right now. So bottom line is, if you have questions about how you view risk, and if you're feeling like you need to change risk because of something that's important and has gone on in your life, not necessarily environmental, right? Environmental in terms of being negative because of what's going on in the news cycle or what it's saying or how it's affecting you. But let's take a look at your life. Let's take a look at your cash flows. Let's take a look at your investment cycle. Let's take a look at your objectives and what you want things to do over the next 10 years. All that's super important. And if necessary, I can run some analysis for you, inputting these particular back-tested returns in place so that you can see how it affects your cash flow, portfolios, whole nine yards, right? And then we'll just keep moving. That's the key. We just keep moving. So I'm always interested in hearing from you. I just want to take a few minutes and relay what I see and what we use every day to strip out the emotion of the market and just simply keep moving forward. So I'm in the same boat with you, right? 100% of my family's retirement assets, 100% of my family's retirement assets are doing the exact same thing that you're doing. I utilize the same models for my portfolios as we're using for you, for the people that we're blessed to serve. So thank you for that. Thank you for your patience. Thank you for your continued trust. I'm always available for a conversation if you need or want. Shoot me an email, chris@careformywealth.com, or give me a call. You have my direct line, 608-354-1977. You can also text me on that line if you'd like, and let me answer whatever questions on your mind. But until then, thank you for your time. Thank you for the weekend, and hopefully you will enjoy the remainder of it. If I don't get the chance to talk to you before Easter, I hope your Easter celebration, if you celebrate it, is blessed. Your Resurrection Sunday is exciting for you, and I hope your family and wish your family the best. God bless. Take care. Bye-bye.